At age 65, some couples may need as much as $413,000 to cover health care costs in retirement. That according to a January report from the Employee Benefit Research Institute. That says a recent column in Cleveland.com. Now, that may be an extreme case representing two people that have high prescription drug costs and perhaps poor health, but it's truly not outside of the realm of possibility. It's one of the most difficult expenses to predict in retirement, says Nancy Nahn, a certified financial planner in Cherry Hill, New Jersey. Now, your healthcare costs are going to depend on your insurance choices, of course, your health, just how often you're going to need medical care, and your prescription drugs and where you live. Now, as you approach retirement, they say to try these tactics to get a handle on future healthcare expenses. And first is to save in your health savings account. If you have a high deductible health plan and access to an HSA or health savings account, they advise to max it out. The money that you save is triple tax advantaged. You do not pay taxes on the money that you're saving, and also the interest you earn in the account or any withdrawals used for health expenses. Now, in 2024, you can save up to $4,150 for an individual health savings account and $8,300 for family coverage. If you're 55 or older, you can contribute even an additional $1,000 a year. Now, you can't save to an HSA once you've signed up for Medicare. Second is to pick the right Medicare plan. When you turn 65, advisors typically tell you to select an original Medicare plan with a Medicare supplement or Medigap insurance. Now, since Medigap plans cover many out-of-pocket expenses of Medicare, that keeps one's monthly health care costs mostly predictable. Now, many older adults, such as the ones we serve in the reverse mortgage industry, are attracted to the $0 premiums of Medicare Advantage plans, but when you use these private health plans, it means you may be limited to just in-network doctors and hospitals. The column says, I've seen many situations where people wind up needing to go see a provider who doesn't take that coverage, and they end up paying the full bill themselves, says Melinda Cahill, a co-founder and CEO of 65 Incorporated. That company offers guidance on Medicare. Then there's out-of-pocket maximums for Medicare Advantage plans, and they can also be as high as $8,500 or $8,850, per year in 2024, and that doesn't include your Medicare Part B medical insurance premiums. That said, if you can't afford a Medigap plan, then Medicare Advantage could be the better choice for some. But without any Medigap coverage, original Medicare really has no out-of-pocket maximum. The third option to control health cost is to get help with your tax planning if your income is exceeding a certain threshold, because you're going to pay each month for Medicare Part B and Medicare Part D for prescription drug coverage. Now, if that is where an individual is, they need to meet with a professional tax advisor and financial advisor and find how they can reduce their taxes and also their taxable income. Fourth, and most importantly, is to pay down your mortgage. It says if you're 62 or older and have at least 50% equity in your home, you could have access to a reverse mortgage later if you really need it. They say it's like a loan or a line of credit on your assessed values home, and you don't have to make payments, which is true. The loan is ultimately repaid, as we know, when the last borrower moves out or passes away. They also add that a reverse mortgage did have a previously scary reputation, but today's products are much safer. And the last piece of advice is a good one. It says to keep things in perspective in the end. Don't lose too much sleep over the big figures. Consider how intimidating it would be if experts also told you just how much you would need to save to cover 30 years of food or utility bills in retirement. That would be intimidating. But with the right planning, healthcare costs can actually be manageable. A reasonable cost is about $6,000 a year for an individual, and if you price that out on a monthly basis, it's $500 a month, says Dick Power, a certified financial planner in Walpole, Massachusetts. That $500 a month typically includes your insurance coverage and also your co-pays. We have some real estate and housing market news. Redfin reports that new home listings increased 13% from a year earlier nationwide, that during the 4 weeks ending on March 3rd. That's the biggest increase in 3 years. The boost in new listings helped bring the total number of homes that are up for sale up by 1.7%. following 8 months of declines. Now, February is the first month the number of homes for sale has increased on an annual basis. Now, home sellers are now beginning to cut their asking price to help entice would-be home buyers. For example, 23% of listings in Texas have price cuts. The percentage of listings with price cuts in other states includes 24% in Oregon, over 28% in Florida, 30% in Arizona, and only 14% of listings in California have seen a price reduction. There have been two major obstacles for home buyers over the last year: low inventory and high housing costs, said Redfin economic research lead Chen Zhao. Now is the first barrier is beginning to come down as more supply comes on the housing market. Housing costs are still high, but they're likely to come down a bit as mortgage rates gradually decline through the year and price growth loses some steam. In other housing news, Newsweek reports that home sales in Texas fell to its lowest level in 7 years in 2023 as persistently high mortgage rates kept buyers out of the market, even as prices dipped modestly compared to 2022, according to a recent report by the Texas Realtors. In 8 metro areas in Texas, the median price of homes decreased, with the biggest drop, 10.4%, in the Austin Round Mark Metropolitan Statistical Area, or MSA. Despite the plunge in prices, the metro area still had the highest median prices in Texas at $450,000. And in our last story, an update on the economy. Following their 2-day policy meeting, the central bank's rate-setting Federal Open Market Committee, or FOMC, said that they will keep the benchmark overnight borrowing rate in a range between 5.25% to 5.5%. That's where it has actually stood since July 2023, according to CNBC. The Federal Reserve last Wednesday held interest rates steady as expected, and they did signal they still plan on having several rate cuts before the end of 2024. Along with that decision, Fed officials penciled in 0.75 percentage rate cuts by the end of the year, which would be the first reductions that we've seen since the early days of the COVID-19 pandemic. I don't like that phrase, in March of 2020. Now, the current federal funds rate level is actually the highest we've seen in over 23 years. The rate sets what the banks charge each other for overnight lending, but it's important because it feeds through to many forms of consumer debt, as we know. The outlook for the 3 cuts came from what they call the Fed's dot plot, and that's a closely watched matrix of anonymous projections from the 19 officials or board of governors who comprise the FOMC. The chart provides no indication for the timing of those moves. Chair Jerome Powell said that the Fed also did not elaborate on the timing of the rate cuts, but he says he still expects the cuts to come as long as data, meaning inflation, cooperates. Future markets following the meeting were pricing in nearly 75% probability that the first rate cut from the Fed would come on the June 11th to 12th meeting, according to the CME Group's Fed Watch Gauge. We believe that our policy rate is likely at its peak for this type of cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year, said Powell in his post-meeting news conference. The chairman also added, "We are prepared to maintain the current target rate for federal funds rate for longer if appropriate," meaning if the inflation data gets hotter, they would. The plot indicated 3 cuts in 2025, one fewer than the last time the grid was updated last December. The committee does see 3 more reductions in 2026 and 2 more in the future until the Fed funds rate settles somewhere in the range of about 2.5%, near what policymakers estimate to be the neutral rate that neither stimulates nor restricts the economy. Higher than expected inflation data beginning in 2024 actually triggered cautionary statements from top Fed officials, and the January FOMC meeting concluded with the central bank saying they need more evidence that prices were indeed deaccelerating before they would begin to gain greater confidence that inflation was tampered and they would begin cutting rates. The sum total of this no news is good news press conference is that the markets continue to have a green light to run higher, said Chris Zaccarelli, Chief Investment Officer at the Independent Advisor Alliance. Fed Chairman Jerome Powell seems determined not to make the same mistake as his predecessor. And if you're not familiar with the name, Federal Chair Arthur Burns cut interest rates prematurely in the late 1970s, and that only further entrenched and exacerbated inflation for several years to follow.